To wrap things up with the yield curve, I wanted to go over a related topic, and this is something I think we're going to explore in greater detail in the future. But we're going to think a little bit about quantitative easing. You probably heard that term quantitative easing. You may not know what it really is. Well, it turns out quantitative easing is something we already know. Quantitative easing is just open market purchases made by the Fed. All right. So QE is quantitative easing. Quantitative easing. And this is basically just open market purchases. And the way we've thought about this affecting the economy is when the Fed buys stuff, that drops interest rates, which stimulates the economy, and it also increases the money supply, which also stimulates the economy. But I want to think about this now in greater detail since we have a better feel for how interest rates are determined and how the yield curve is used. So, there's actually a couple different theories here of why open market purchases stimulate the economy. So let's think about the effects. Now, first of all, open market purchases, they increase the money supply. We know that. We know that can stimulate the economy, okay? So that's a separate thing. Increased money supply, really simple idea, right? Increase the money supply, that means that people have more disposable income. Prices will be slow to adjust, so people have more money. Prices stay roughly the same. People buy more, stimulates the economy. The interest rate part of it, though, is a bit more confusing, all right? And we've talked about how the federal funds rate can kind of help steer things, but it's not quite as simple as that, all right? So let me give you a couple different theories here. And the first theory is called portfolio theory. And if you end up getting a degree in finance from grad school, you'll spend a lot of time talking about portfolio theory and the other prevailing theory, the signaling theory, okay? The portfolio theory looks at this, okay? When the government buys bonds, the government doesn't buy bonds. That would be weird. When the Fed buys government bonds, all right? When the Fed buys government bonds, this reduces the supply of bonds for sale, okay? So there's a certain amount of bonds out there in society, and when the Fed goes in and buys $200 billion worth of bonds, they are reducing the available supply of bonds, okay? So if we think about the market for bonds like this, where this is supply and this is demand, this is going to be kind of weird, all right? Because normally if you think that an entity is buying bonds, that would mean an increase in demand. We could think about it that way if we wanted to, but I don't like to think of it that way, okay? Because here's the thing, the Fed, they kind of make their own rules. They're not really in the markets, all right? If we think of the bond market, that is, businesses, municipal governments, state governments, national governments, individual consumers, that's those people. The Fed is kind of separate. It's kind of like the rule maker, okay? In other words, it doesn't buy bonds because bonds are a good investment. It doesn't issue bonds to borrow money. No, it can create money whenever it wants. So when it enters this market, it doesn't feel like a market activity that's occurring, all right? So in other words, when the Fed buys $200 billion in bonds, that's not like a change in demand. That is a reduction in supply. It's as if $200 billion in bonds just evaporated. So we see a reduction in supply, okay? And that's going to do a couple different things, all right? Imagining they only buy governmental bonds, okay? If they only buy governmental bonds, the reduction in governmental bonds is shown right here by A, okay? This is a tricky little graph that we're about to do. But what that A shows you is the reduction in government bonds. Okay? In other words, the Fed is targeting government bonds only. There are tons of different bonds in the market, but if the Fed only buys the governmental bonds, A represents the reduction in governmental bonds. All right, that's how far left the supply curve shift. That gap between supply 1 and supply 2, that is the reduction in governmental bonds that the Fed just took out of the market. Okay, but notice that the equilibrium is higher. So there's two effects. One is represented by A. That is the government's bonds gone. They're no longer in the market. They might as well be completely invisible, right? They're completely gone. No one can buy them anymore. The Fed has them. Who knows what they're going to do with it? The other thing that happens is the price goes up, okay? So the other thing that happens is the price goes up, which means that the interest rate goes down. Who likes that? Who likes it when the price goes up and the interest rate goes down? The borrowers, the bond issuers, all right? This means if you're somebody who's about to borrow, you can borrow more money now, higher price. This means if you're a borrower, you pay back a lower interest rate. So the second effect that we see is we get a reduction in governmental bonds, but we get more borrowing from other entities. So B represents increased borrowing by other entities. Okay? And that stimulates the economy. So this stimulates the economy. That's good for the economy, okay? Remember that the more borrowing here, this is not going to be governmental borrowing. This is going to be private market borrowing most likely, okay? So this is people borrowing money to buy a house, right? Since all those governmental bonds are gone, price goes up, interest rates go down, so I'm more likely to borrow money for a house, more likely to borrow money to start a business, okay? So that will stimulate the economy. So this is one way that monetary policy, increased monetary policy through Federal Reserve open market purchases, one way that it can stimulate the economy that we haven't fully explored. It's called portfolio theory because think about investors. Investors want a lot of different assets. And one asset they'd like to have is long-term bonds. But if the Fed buys up the long-term bonds, they're going to be forced to pay a higher price. Okay? But given that they would like long-term bonds in their portfolio, they'll still buy some. Okay? So it's portfolio theory, which basically suggests that if you take long-term bonds out of the market, the bond buyers will demand to still maintain a certain level of bonds. All right, so they'll be willing to pay more for bonds. That's why the price goes up, and that will initiate more borrowing in the market. All right, that's kind of complicated, okay? The other theory, thankfully, is a little easier. The other theory is signaling theory. Okay, and to best explain this, let's make sure we're focusing on the Fed buying long-term bonds. Most governmental bonds are long-term, right? Not all, but a lot of them are. They're disproportionately long-term relative to other bonds. Let's put it that way. In other words, if you think about all the long-term bonds that exist, a big share of those is made up by the government, okay? So they make up a lot of the long-term bonds. So if the Fed buys long-term bonds, what will that do to the yield curve? If you had to guess, okay? If the yield curve looks like this prior to this change, what will this do? Okay? Can you think about it? Most likely what this means is if the Fed is buying long-term bonds, that will raise the price of other long-term bonds and reduce long-term interest rates. Okay, and we showed that in that last supply and demand graph. It won't do too much for short-term bonds, okay, because the Fed's not buying short-term bonds. There's not a big effect in that market, but it will have a big effect in the long term. So that's kind of the change we would expect to see there. When the Fed engages in open market purchases, quantitative easing, and they do it specifically buying long-term governmental bonds, that reduces long-term interest rates. Okay? So let's think about signaling theory and why this would be relevant. The idea of signaling theory is the Fed is signaling its intentions, okay? After the QE, after the quantitative easing, all right, I'm using that term now because I want you guys to get a little familiar with it. After the Fed buys stuff, all right, governmental bonds, after QE, interest rates in the long run are lower, okay? Not only are interest rates on long-term bonds lower, but that also would reduce the expectations of future interest rates, okay? All right, so not only do, you can basically think of it this way. If the risk premium stays the same, this must be driven by expectations to some extent, right? Okay? In other words, if this gap is staying constant over time, then we just shift that gap down and you recognize that expectations have dropped. And that is really important, okay? Imagine you have a bunch of bonds, okay? You've been buying up bonds like crazy, like the Fed is doing here. Would you like it if bond prices in the future were high or low? All right? If you got a bunch of bonds, remember you can sell them, right? You can sell them on the secondary market. So you would prefer bond prices to be high, all right? So the theory of the signaling effect is this. When interest rates in the long run are lower, saying the same thing in a different way, and prices in the long term are higher, the Fed wants to keep it this way because it's in their best interest. Remember that the Fed does care a little bit about profits. It does care a little bit about not getting itself into a financial bind. The Fed doesn't want to have to print money to cover up its mistakes. Instead, it would actually like to do kind of some smart investing, okay? It cares about its balance sheet. When the Fed turns a profit, it gives it to the federal government. It'd like to do more of that, okay? And to do more of that, it actually needs to keep prices high. It needs to keep interest rates low in the future, okay? So how do they keep interest rates low in the future? Keep pumping money into the economy, right? Keep the federal funds rate low. And that is a situation that investors like, right? If you think about the economy is stronger in the short run when interest rates are low. So what the Fed is going to do here is it's going to buy long-term bonds, now be stuck with a bunch of long-term bonds, and investors will look at the Fed that's holding all these bonds and say, well, they're going to try to keep interest rates low so they can sell those bonds at a profit in the future. All right? So now investors expect the Fed to keep rates low. Which will help keep the economy strong. Okay? So it's a signal in the sense that the Fed, who cares about their monetary system, the Fed is going to have to keep interest rates low. And if they do indeed keep interest rates low in the future, that alone will keep the economy strong. So this makes the Fed look more dovish, if you've ever heard that term, right? The idea of the Fed being dovish is the fact that they're like a dove, keeping things peaceful, keeping things easy, keeping the economy strong. So this is indicative of the Fed being forced to make choices that keep the economy strong in the long run. And if the economy is strong in the long run, people feel good about the economy today, right? Because they are forward-looking. They exhibit expectations, all right? So we're going to talk more about this in the future because when we talk about the Great Recession, the 2008 period, the Fed did a lot of crazy things. They did lots of quantitative easing. They did something called Operation Twist, where they intentionally bought long-term bonds and sold short-term bonds at the same time. And so this will give us just a little bit of a taste for this as we move into the later lessons.